For 2 straight years, Florida was the American dream. Over 700,000 moved in, bidding wars broke out, and home prices in Miami, Tampa, and Orlando surged as much as 60%. But today, experts warn Florida is facing the biggest real estate collapse in U.S. history. Insurers are fleeing. Premiums have soared up to 500%. And a home that sold for $650,000 in 2022 now sits unsold at a loss. The sudden reversal has pushed out more than 250,000 people in just months, and the true cost is only starting to emerge. How did the nation's hottest market become the epicenter of risk and retreat? And how bad could the fallout get? The numbers tell the story. Between 2020 and 2022, Florida gained over 700,000 new residents, more than any other state in the country. Drivers packed up moving trucks, loaded U-Hauls, and set their sights on the Sunshine State. Census tables show the population swelling in real time. Miami-Dade, Hillsborough, and Orange counties each reported tens of thousands of arrivals in a single year. The U-Haul Growth Index ranked Florida as the #1 destination for one-way moves 2 years running. With rental demand so high that trucks returning from the Northeast and Midwest were in short supply, people came from everywhere. Remote workers fleeing city lockdowns, retirees chasing warm winters, families looking for bigger homes and lower taxes. In 2021 alone, Florida's net migration outpaced Texas, Arizona, and the Corollas combined. Local officials scrambled to keep up, issuing new building permits and adding lanes to highways that jammed with out-of-state plates. School districts hired teachers by the dozen. This surge wasn't just a blip. Rental vacancies disappeared. Suburban subdivisions in Tampa, Orlando, and Fort Lauderdale filled up months ahead of schedule. Real estate agents fielded calls from buyers in California, New York, and Illinois, some offering cash, others willing to waive inspections and appraisals just to get a foot in the door. In Cape Coral and Palm Coast, population growth exceeded 5% in a single year. The state's overall growth rate was the fastest since the 1950s land rush. Signs of the boom were everywhere. Sold-out new construction, wait lists for condos, lines at open houses that stretched down the block. For 2 years, demand seemed endless. Every new arrival added fuel to the fire, pushing the buyer pool higher and higher. The promise of sun, base, and opportunity drew more people to Florida than at any point in recent memory. But behind the numbers, a speculative mindset began to take hold, one where the only direction for prices and fortunes was up. Home prices in Florida didn't just climb, they rocketed. In Miami, Tampa, and Orlando, the median sale price soared by 45 to 60% in less than 2 years. Bidding wars broke out over every 3-bedroom ranch and high-rise condo. Listings that once lingered for weeks vanished in hours. Agents started skipping open houses altogether, knowing the home would be under contract before the weekend. Cash ruled the market. Investors and out-of-state buyers came armed with wire transfers, beating out anyone relying on a mortgage. In some neighborhoods, more than half of all sales closed without financing as buyers raced to lock in properties before prices jumped again. Stories from the boom sound almost unreal. In Fort Myers, a family from California arrived in 2022 and paid $650,000 for a 4-bedroom home in a new subdivision. They offered $50,000 over asking and waived the inspection. The builder had a waiting list stretching into the next year. The family believed that they were buying into a future of endless appreciation, a safe haven from California wildfires and high taxes. Their neighbors, too, were recent arrivals. Some from Chicago, others from New Jersey, each convinced that Florida's sun and rising values would protect their investment. Speculation became a way of life. Local Facebook groups buzzed with tips on flipping pre-construction contracts. Airbnb hosts snapped up condos, betting on a new wave of tourists and remote workers. Real estate seminars promised quick riches for anyone willing to buy now and sell before the next hurricane season. The word bubble was whispered, but brushed aside. Everyone seemed to know someone who just made six figures on a resale. The fear of missing out drowned out caution. Numbers backed up the frenzy. In Tampa, cash buyers made up nearly 40% of sales in 2022. In Miami, investor purchases hit all-time highs. Title companies worked overtime, closing deals at a pace not seen since the last housing boom. Behind every record sale, there was a buyer convinced that Florida was different this time. But as prices climbed and the market heated up, the risks hiding beneath the surface grew, larger and far harder to ignore. Insurance companies began pulling out of Florida in waves, leaving millions of homeowners scrambling. In less than 2 years, 6 major carriers withdrew from the state, or sharply reduced their business. Each exit triggered a cascade. Tens of thousands of policies canceled overnight. Notices arriving in mailboxes with little warning. The Office of Insurance Regulation tracked the trend in real time. St. John's Insurance liquidated in March 2022. FedNat canceled over 50,000 policies before being forced into receivership, and UPC Insurance announced its withdrawal that August. By early 2024, more names joined the list, each citing the same problems: catastrophic hurricane losses, runaway litigation costs, and reinsurance bills that doubled in just 3 years. As private insurers retreated, the burden shifted squarely onto Citizens Property Insurance, the state-backed insurer of last resort. Citizens' enrollment exploded from under 500,000 policies in 2019 to over 1.3 million by the middle of 2023. In Miami, Dade, and Broward counties, Citizens now holds more than 40% of all residential policies. For many neighborhoods, it's the only option left. Every new hurricane season brought fresh fears. After Hurricane Ian in 2022 and Idalia in 2023, carriers faced billions in claims. Global reinsurers, who provide the financial backbone for local insurers, raised their prices by 30 to 50%, or pulled out entirely. Florida carriers now spend more than half of every premium dollar on reinsurance, double the national average. The math no longer works. Insurers say actuarial models predict losses that can't be covered, not at any price homeowners can afford to pay. Even the state's legal reforms, meant to cut down abusive lawsuits and fraud, haven't been enough to lure carriers back or lower costs. The swelling ranks of Citizens policy holders come with their own risks. Citizens was designed as a safety net, not a primary insurer for a state of 22 million people. Its reserves are built for a 50-year storm, but a single 100-year hurricane could wipe out its ability to pay claims. If that happens, every Florida policyholder faces the prospect of emergency assessments and higher taxes to cover the shortfall. Internal actuarial reports warn that Citizens' financial cushion is thinning with each new policy added. The more the private market shrinks, the more the state becomes exposed to a disaster it cannot fully insure. Industry filings show that in high-risk counties, more than half of homeowners now rely on Citizens for coverage. In some coastal zip codes, private insurance is no longer available at any cost. The problem isn't just storms. It's the cost of reinsurance, the volume of lawsuits, and the growing sense among global insurers that Florida's risk is unmanageable. Each carrier that leaves deepens the crisis, pushing more homeowners toward a system never meant to carry this weight. The safety net is fraying, and with every hurricane season, the risk grows that it won't hold. Retirement in Florida once meant sunshine and peace of mind. Now it comes with a stack of bills that many never planned for. In Naples, a retired couple opens their renewal notice and finds the premium has jumped from $3,000 to $14,600 in just 3 years. Their neighbors living on the same street face an even steeper climb. One couple's waterfront policy now exceeds $18,000 a year. These aren't luxury mansions. They're modest homes built for quiet years, now priced out by a system that no longer makes sense. monthly budgets have become battlegrounds. For a median-priced house in Tampa, insurance alone runs between $4,200 and $6,500 each year. That's 3 to 5 times the national average. Property taxes, once a selling point, have climbed by 25% in many counties as new assessments catch up to the boom. In some neighborhoods, HOA fees have soared by 30% or more as entire communities scramble to cover their own insurance gaps. Every line item gets squeezed: maintenance, reserves, even basic utilities, until the numbers no longer add up. For retirees on fixed incomes, the math is unforgiving. The Naples couple living on Social Security and a small pension now faces an extra $1,000 a month in housing costs compared to just a few years ago. Their options are limited: drain savings, cut essentials, or sell the home they thought would be their last. Local insurance agents say they've never fielded so many calls from longtime residents desperate for relief, or so many tearful conversations about leaving Florida altogether. Budget worksheets tell the same story across the state. In Tampa, a $420,000 house now carries a total annual burden: insurance, taxes, HOA, easily topping $12,000 before a single mortgage payment is made. For younger families, the strain is just as real. Adjustable rate mortgages, once a ticket into the market, now reset at 7 or 8%, turning what looked affordable into a monthly scramble. Some skip coverage and hope for a quiet hurricane season. Others try to rent out rooms or take on second jobs just to keep up with bills that never seem to stop rising. The insurance crisis isn't just a headline. It's a daily calculation for millions forced to choose between staying put and financial safety in Naples and Tampa and across the state. The promise of Florida is colliding with a reality no one can budget for. Hurricane Ian struck Florida in September 2022, carving a path of destruction from Fort Myers Beach to Orlando. Winds topped 150 miles per hour. Entire neighborhoods disappeared under storm surge. The insurance industry tallied the losses at $113 billion, making Ian the costliest hurricane in Florida's history and the third most expensive natural disaster ever recorded in the United States. Not a year later, Hurricane Idalia swept through the Big Bend region, flooding small towns and flattening homes that had stood for generations. The damage from Idalia added billions more to the state's mounting catastrophe bill. These storms are not rare events anymore. NOAA's latest projections show that Florida's future is defined by rising water. Sea levels along the state's coastline have climbed 7 inches since 1950. By 2050, that rise could reach another 18 inches, submerging streets that today seem safe. The AWISE models estimate that $1.2 trillion worth of Florida coastal property is at risk from chronic flooding and storm surge within the next 25 years. In Miami-Dade, Collier, and Lee counties, entire zip codes sit within the new floodplain maps, places where insurance is often unavailable at any price or offered only with sky-high deductibles and exclusions. For insurers, the math has changed. Catastrophe models that once treated a Category 4 hurricane as a once-in-a-generation event now show billion-dollar storms arriving every few years. The actuarial tables used to set premiums and reserves have been rewritten to account for this new reality. With each storm, the cost of coverage climbs and the appetite for risk shrinks. Global reinsurers who backstop Florida's insurance market are demanding higher rates or refusing to renew contracts altogether. The result, a market where the physical threat is no longer theoretical, but a constant looming presence. The landscape has shifted from manageable risk to permanent vulnerability. Homeowners, lenders, and insurers are all forced to confront the possibility that parts of Florida may become uninsurable long before they are underwater. The storms of the past 2 years have exposed the limits of the old models, and the price of ignoring the warning signs now sits in the billions, with more to come. Market data now shows how quickly confidence has vanished in Miami, Tampa, and Orlando. Inventory has surged by 85% compared to last year. Homes that once sparked bidding wars now sit unsold for months. The average listing stays on the market for 90 to 120 days, up from just 20 days at the height of the boom. Sellers who expected quick offers are lowering their prices, often again and again, just to attract a single showing. Across major metros, median sale prices have fallen 8 to 15% from their peaks. In some coastal neighborhoods, the drop is even steeper, with sellers slashing asking prices by $100,000 or more and still finding few takers. Distressed sales are piling up. Owners who bought with floating rate mortgages or minimal down payments are especially exposed. When insurance premiums and property taxes spike, carrying costs can jump by hundreds or even thousands of dollars a month. Some investors, unable to cover their costs with rent or short-term bookings, are rushing to unload properties before losses mount further. Redfin and MLS data show a sharp uptick in price cuts, canceled contracts, and homes returning to the market after failed deals. Cash buyers, once the engine of Florida's boom, are pulling back. Statewide cash sales of single-family homes have dropped by more than 20% year over year. Investor activity in Fort Lauderdale and Orlando is down by a quarter as returns vanish and risk becomes impossible to ignore. The result is a market that feels frozen. For every new listing, there are fewer serious buyers. Properties linger unsold as owners weigh their options, cut the price, rent at a loss, or walk away. The numbers reveal a simple truth: liquidity has dried up. The flood of buyers that once fueled record growth has turned into a trickle. Each new data point, rising inventory, falling prices, longer days on market, confirms that Florida's real estate market is no longer just cooling, it is seizing up, with sellers stranded and buyers nowhere to be found. The outflow has begun. New census data shows that in the first half of 2024, more people left Florida than arrived, a reversal that hasn't happened in decades. The numbers are stark: 275,000 more departures than arrivals, a net loss that stands in sharp contrast to the pandemic boom. U-Haul and moving van companies now report more trucks leaving the state than coming in, a mirror image of the frenzy just 2 years earlier. Stories behind the numbers reveal a pattern. Families who moved for affordable living now face costs they can't manage. Retirees on fixed incomes watch their insurance bills and taxes swallow savings. Some pack up after just a year or two, selling at a loss or walking away from homes they thought would anchor their future. Recent transplants from New York and California, lured by the promise of sun and space, now list their properties after realizing the true cost of staying. Locals priced out by rising rents and taxes join the exodus, searching for jobs and housing in neighboring states. This reversal hits every corner of the state. In Miami, Dade school districts report falling enrollments for the first time in a generation. In Orlando, daycares and small businesses note fewer new faces. Real estate agents who once fielded a dozen buyer calls a day now spend hours tracking down sellers eager to leave. The shrinking population has an immediate effect on the market. Fewer buyers means more homes sit unsold. Inventory piles up, and the sense of urgency that once drove bidding wars has evaporated. Sellers slash prices, but with so many competing listings, discounts are no longer enough to draw interest. Every family that leaves takes with them the hope of a quick sale and the expectation of rising values. For the first time in years, demand is not just cooling, it's vanishing. The engine that powered Florida's real estate boom has stalled, replaced by uncertainty and a growing sense that the cycle of growth has come to an end. Construction sites that once buzzed with activity now sit silent across Florida's hardest-hit cities. In Cape Coral, building permits are down by half compared to last year. Contractors who worked overtime during the boom have started laying off crews. The Florida Department of Economic Opportunity reports thousands of construction jobs lost since late 2024, with the biggest cuts in Lee, Penless, and Collier counties. Developers who once scrambled to pour foundations are canceling projects, shelving plans for entire subdivisions as buyers disappear and financing dries up. National trade groups say Florida now accounts for a quarter of all new project cancellations in the country. With billions in planned homes and condos put on indefinite hold, the pain doesn't stop at the job site. Local governments are feeling the squeeze as property tax revenue falters. For the first time in a decade, in Cape Coral, city budget hearings reveal a $38 million shortfall, blamed directly on falling home values and stalled sales. Naples officials warn of service cuts from park maintenance to fire staffing as the tax base shrinks. St. Petersburg and West Palm Beach face similar gaps, with at least a dozen counties across the state forecasting property tax declines of 3 to 9% for the coming year. The reversal is stark. Just 2 years ago, these same cities posted annual gains of up to 10%, fueled by soaring assessments and relentless new construction. The ripple effects are everywhere. With fewer new residents, retail and hospitality businesses see sales slip. Short-term rental bookings have dropped, dragging down hotel and bed tax collections in tourist hubs like Orlando and Tampa. City councils debate how to cover budget gaps as business tax receipts stagnate or fall for the first time since the pandemic. The Florida Realtors Association reports a wave of agency closures and layoffs, with offices consolidating or shutting down in markets that once couldn't hire fast enough. The numbers are clear. More than 10,000 construction workers have lost their jobs since last fall. Single-family building permits are down 40 to 60% from their 2022 peak in major metros. Property tax revenues are falling in at least 12 counties. Each domino that falls, every canceled project, every job lost, every budget cut makes it harder for communities to recover. For the first time since the last crash, the economic fallout of a real estate bust is hitting Florida's towns and cities in real time, with no easy fix in sight. Bankers in Florida are running the numbers, and the warnings are getting louder. On recent earnings calls, risk officers from Suncoast Bank and Gulfstream Financial flagged their exposure to Florida real estate as their top concern for 2025. Internal memos now circulating through regional banks estimate that if home prices drop another 20 to 30%, a scenario many analysts now consider likely, over $1 trillion in property value could vanish from the state's balance sheets. The Federal Reserve's latest stress test flagged more than 50 Florida-based banks for heightened monitoring, citing their heavy concentrations of residential and commercial real estate loans tied to hurricane-prone and flood-exposed markets. The implications stretch far beyond state lines. Florida holds nearly 12% of all outstanding U.S. residential mortgages. If the market corrects by 30 or 40%, as some projections suggest, the resulting $1.4 trillion in lost value would ripple through the entire financial system. Mortgage-backed securities, pension funds, and insurers nationwide would feel the shock. Moody's and S&P have both issued notes warning that loan performance in Florida is deteriorating faster than anywhere else in the country. S&P's third quarter bulletin cautioned significant loan impairment in Florida could trigger broader regional bank contagion absent federal intervention. The government-sponsored mortgage giants Fannie Mae and Freddie Mac are also taking steps. In 2024, both agencies began limiting their exposure to Florida loans, refusing to purchase or refinance mortgages on properties that lack full wind and flood coverage. The National Flood Insurance Program caps payouts at $250,000, far below the value of many coastal homes, leaving a growing segment of the market effectively unfinanceable. Lenders now face a stark choice: call-in loans on underinsured homes or risk-carrying assets that may soon be worth a fraction of their original value. Policymakers in Tallahassee have tried to stem the tide. Governor DeSantis signed Senate Bill 2A and Senate Bill 7052, aiming to curb lawsuits and attract new capital to the insurance market. But industry filings and analyst reports agree these reforms tackle legal costs, not the core actuarial crisis. Hurricanes, reinsurance costs, and climate risk remain unsolved. As one bank risk officer put it, "We're not just worried about Florida anymore. If this spreads, it's a national problem." The numbers are unforgiving. A 20 to 30% further drop in home prices, a potential $1.4 trillion in wealth destruction, and a recovery timeline that some experts now stretch to a decade or more. Every day, the risk of contagion grows, not just for Florida's banks, but for the broader American economy. The collapse is not unfolding evenly across Florida. In coastal hotspots, the damage is plain. Panama City Beach, once a magnet for short-term rental investors, now faces a glut of empty condos. Airbnb listings outnumber available bookings 3 to 1. Owners who bought in at the peak, many with 20% down and variable rate loans, are now chasing renters in a market that's oversaturated and shrinking. Negative. Cash flow is common and forced sales are rising as investors run out of options. The Keys have seen some of the steepest drops. Flood insurance requirements have tightened after new FEMA maps expanded high-risk zones. Many homes, even those untouched by hurricanes and garrison, are now considered uninsurable or face premiums that swallow up any rental income. Median sale prices in parts of Monroe County are down more than 15% from their 2022 highs. Listings sit for months, and even deep price cuts can't lure buyers back to properties that banks won't finance. Cape Coral, hit hard by Hurricane Ian, stands as a warning. After the storm, FEMA redrew the floodplain, pushing thousands of homes into higher risk categories. Insurance bills soared and special assessments from HOAs piled on. Inventory shot up by over 30%. The foreclosure rate doubled in neighborhoods where private carriers withdrew, forcing owners onto costly citizens' policies. Appraisers now talk about permanent value impairment for the most vulnerable blocks, homes that may never recover their lost equity. Further inland, the picture is different but far from stable. The Villages, a sprawling retirement community once thought immune to coastal risk, is now seeing its own correction. Prices have flattened, and some neighborhoods report double the number of homes for sale compared to last year. Rising insurance costs and HOA fees are hitting even these planned communities, prompting some retirees to reconsider whether Florida is still the right place for their fixed incomes. Rental data shows the same pattern. In Panama City Beach, RB average monthly rents have dropped 12% in a year, with vacancy rates climbing. Inland suburbs, once insulated from the worst of the storm-driven chaos, are now facing a slow bleed as investor demand fades and population growth stalls. The pain is sharpest where climate risk and insurance costs intersect, but nowhere is truly untouched. The map of Florida's real estate collapse is a patchwork. Coastal, inland, north, and south, each with its own version of distress, but all pointing to a market where the old rules no longer apply. In just 2 years, Florida's net migration flipped from a record inflow of 700,000 new residents to a net loss of 275,000 people in early 2024. This reversal, combined with an 85% surge in housing inventory and insurance premiums that have risen 400 to 500%, has exposed the fragility of Florida's real estate boom. Documented failures in the insurance market, escalating costs, and climate-driven disasters like Hurricane Ian's $113 billion in damages have led experts to warn of further declines, another 20 to 30% over the next decade. Yet the full impact on regional banks, state finances, and future migration remains unclear. What is certain is that the collapse was driven by measurable risks, unchecked population growth, speculative investment, and mounting climate threats. As policymakers scramble for solutions, the evidence shows Florida's reckoning is reshaping the national conversation about where Americans live, invest, and retire. The consequences of this crisis will unfold for years, marking a turning point in U.S. real estate history.